Two videos released by a Syrian rebel-affiliated media outlet today show the aftermath of airstrikes on a school in Damascus and underscore the brutality of the war. They were downloaded before a nationwide ceasefire goes into effect midnight Syrian time. The truce was confirmed by the Turkish Foreign Ministry. Russia and Turkey have both backed the deal. Argentina has reopened its investigation into an accusation against former President Cristina Fernandez. She's accused of covering up alleged Iranian involvement in the 1994 bombing of a Jewish community center. 85 people died and hundreds of others wounded. The accuser, Alberto Nisman, was also found dead. Earlier this week, a judge approved fraud charges against Fernandez and two aides and ordered her assets frozen. President-elect Donald Trump is turning to former presidents John F. Kennedy and Ronald Reagan for inspiration for his inaugural address. That's according to the Washington Post. Meanwhile, Trump wants to keep the speech short and will spend at least part of today working on it. Presidential historian Douglas Brinkley tells CNN that Trump wants to write the speech himself. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
Live from Bloomberg's World Headquarters in New York, I'm Julie Hyman.
I'm Joe Weisenthal.
And I'm Oliver Rennick. We're 30 minutes away from the close of trading here in the U.S.
And U.S. stocks are little changed at this hour, seeing a little bit of a pause.
The question is, what do you miss?
Risk assets appear to be taking a breather with just one more trading day left for 2016. U.S. stocks little changed on the day. Oil retreating from its highest close in 17 months. Treasuries extending gains after a strong 7-year auction. Sears CEO Eddie Lampert is opening his wallet yet again to help keep the struggling retailer in business. He's offering a $200 million lifeline, but that amount could grow to as much as $500 million. And the U.S. retaliates against Russian interference with the 2016 election. The Obama administration announcing sanctions against Russian officials and expelling 35 operatives from the U.S. We'll have the latest developments from Washington as well as from Moscow. We are now getting some headlines, in fact, from a Russian conference call saying that the Russian reaction will create discomfort for the U.S. and that Russia regrets Obama's decision on new sanctions. He also says the spokesperson there, the Kremlin spokesman, that the U.S. sanctions are an attempt to undermine the Trump administration. Now, looking at the markets here, as we get all of this geopolitical news, we've not seen much reaction. Let's see where the major averages stand as we head towards the close. Bloomberg's Abigail Doolittle is standing by.
Hi there, Julie. Well, you're right about that. Not a lot of reaction at all. We have the three major averages of the Dow, S&P 500, and NASDAQ, all largely unchanged going into the close. Very, very slight declines going into the close. It is important to note, though, this is the second down day for U.S. stocks following a more significant pullback yesterday. It appears that investors are taking a little bit of a breather within the Trump rally. Now, when we take a look at other asset classes, there is a bit of a risk-off tone to today's trading action. We take a look at the Bloomberg Dollar Index along with the 10-year yield and gold. We should be coming up any moment. The Bloomberg Dollar Index is down for the first time in 4 days. We also have the 10-year yield trading higher, along with gold trading higher. Gold is having its best day since September. So a little bit of a risk-off feeling there. And here we have the Bloomberg Dollar Index down 0.5%. Again, the first down day in 4. The 10-year yield is higher, down 3 basis points, represented in green. This does tell us that bonds are rallying, and gold up 1%. Again, so a little bit of a safe haven flare here. And we take a look at the VIX, silver, and yen. It extends. The VIX, in fact, is higher for the 5th day in a row. We also have, and here is a terminal chart of the VIX. This is #BTV 4350. In orange, we have the VIX over the last year. In white, we have the S&P 500. So as the VIX has been carving out the S&P 500 has been carving out new record highs. The VIX going toward lows. We do see that when the divergences have been big in the past, they tend to converge. So perhaps in the beginning of the new year, Oliver, we're going to see stocks drop and the VIX trade higher as complacency leaves the market. I know that you're taking a look now at Sears.
Hey, fine by me if complacency leaves. That makes for great stories and great reporting, right? Sears stock, though, is indeed rising today after the struggling retail chain got some short-term financial relief. That relief came in the form of a $200 million letter of credit from its CEO, Eddie Lampert, or more specifically, technically, it's a credit line that could be expanded by as much as $300 million, and it comes from affiliates of ESL Investments, Lampert's own firm. So let's see what the numbers show about Sears. In today's, the numbers don't lie. Lampert is the billionaire behind Sears, and he needs funding for his company, which you can clearly see right here. They just suffered a pretty big quarterly loss, that last bar. And basically what happens is you've got a cumulative damage of about $9 billion in the past 8 years. According to one analyst at Moody's Investor Service, that means the company needs to raise about $1.5 billion just to make it through 2017. Lampert has spent years propping up Sears by selling off its household brands and its real estate, not by any kind of growth in its brick-and-mortar stores. If you just take a look at the decline in the company's store count, the financial loss is a result of those slumping comparable assets. And right there's the store count. You can see it's been coming down except for one little blip right there. That's the only quarter of positive sales growth since 2000, right there in 2010. And last quarter, same-store sales dropped more than 7%, which includes a 10% plunge at U.S. Sears locations. It wasn't supposed to be this way, of course. Lampert merged Sears and Kmart in 2005, and investors were hopeful, betting on the company's underlying real estate value, which at the time sent the shares above $100. But sales and the stock have never really picked up. In the meantime, the restructuring continues, and the company may sell its Craftsman, Kenmore, and Die Hard brands, along with some of its Sears home services businesses, in order to stem all those losses. Sears CFO said today in a statement that the company has numerous options for financing. The story with Sears is certainly more about the funding, at least today, than it is the stock. Joe?
Thanks, Oliver. For more on what's next for Sears, let's bring in Noel Hebert of Bloomberg Intelligence, who's with us from Princeton. Noel, what is next for Sears? What is the stage? So they have this extra slug of cash, but where does the company go strategically?
I think you got to ask a handful of questions there in terms of where they go strategically, right? So I think store closures, as was just alluded to by Oliver, are certainly part of the play here. But I think one of the things you also have to be mindful of is the agreement that they had struck with the Pension Benefit Guaranty Corp last year in terms of the springing lien language that kicks in around like $1 billion market cap. That could become an issue for them related to whether it's some of the real estate assets as well as some of the KCD or Kenmore Craftsman Die Hard properties early in the new year. But realistically, I think, you've got to look and take a deep evaluation of, what are the prospects. The liquidity is very, very tight. So referencing that Moody's report that Oliver referenced, I mean, if you're looking at $1.5 billion cash need next year, that's going to have to be Eddie.
No, this is supposed to be a good time of year for the retailers, even for Sears, right? I mean, it's supposed to be a time that cash is coming in. So what does it tell us that this news is coming now at the end of December?
Well, I think that's actually probably the most concerning item about today's, and I know there's certainly been a positive reaction to the incremental liquidity, but I think you have to be mindful of why you need the liquidity. So as a letter of credit, you're basically using that to guarantee vendors are going to get paid at the end of the day. Typically, they've funded that off of their revolving credit facility. The fact that Eddie has to step in here raises some concern that maybe they're not going to have all the liquidity or availability under the revolver itself. So they need this incremental hand, and that could point to either cash losses in Q4 or maybe just a reduced inventory position or a number of other items that aren't necessarily super great for the long term.
No, let's talk about the business that's happening at their storefront. Fun fact, guys, you may not know this, Sears was my first job ever. Sold tractors and tools. And I remember people come in for the tools, right? The Craftsman, lifetime guarantee, all that good stuff. So if they're thinking about selling that off, what does that say about the future of their storefront and their brick and mortar stores?
Well, I think, I mean, there's a little bit of kind of codependency there, right? Because part of the value of the brand is contingent upon the health of the stores. So I think to some degree, if you're trying to preserve the value of those enterprises, you've got to try and monetize them sooner rather than later before the store count is so reduced that it cuts into the valuation of those enterprises. But we haven't really seen big bids emerge for that, right? Because we saw, Stanley bid for the Newell assets instead of the Sears assets. So it's not really clear who the bidders are. There was a filing earlier in December that indicates that they might be engaging sort of some affiliate parties to kind of take a look at those assets. So, I mean, the big thing I think at this point is trying to keep those out of the hands of the PBGC so that Eddie and Fairholme and the affiliates can kind of make sure they realize whatever value is derived therefrom.
Oliver mentioned Craftsman. Does the Sears brand itself, Sears, have much value at this point?
I guess it depends on who you ask. I suspect, you know, given the nature of like the incentive programs and everything else like that and the way they're trying to transform both Sears and Kmart, I think, you know, Eddie and the company would argue yes. I think, you know, Julie and I probably had this conversation almost a year ago now where there was a lot of talk about whether there was any brand relevancy left to Sears. I think that's an open question, but, you know, it's certainly reduced if there is some.
No, the other discussion that we have been having ongoing for probably longer than just the past year is why Eddie Lampert keeps going with this thing, why he keeps putting money into it, why he never turned it into sort of a bigger investment vehicle, as was the original hope for his investment here. There's sort of this mystery at the center of the story. Do we have any kind of insight into what he's thinking?
Well, I think, you know, when you look back to when he originally merged Kmart and Sears, the goal was to kind of only focus on things that delivered what he thought were going to be strong ROI opportunities. And so he was really just focused on underinvesting in the stores, lowering marketing and that sort of thing to generate cash flow and return money to shareholders, and thereby kind of boosting his own stake because he didn't sell any of his own shares. I think as time went on and the sales started compounding negative, it sort of changed the long-term trajectory there for them. And now it's sort of about preserving what value there is in the enterprise. And if you notice over the last sort of year and change, a lot of the lending that Eddie has done or that he did with Cascade, with the short-term term loan, a lot of it's secured, right? It's going to be backed by real estate. It's going to be backed by some other collateral pool. So he's not exactly going in naked into these positions. I
was just looking at the Bloomberg relative valuation. Sears debt to capital, both a function of pretty high debt and small capital, basically lends itself to a pretty high percentage. How, when we look forward and take the story forward, what are sort of the next signs to figure out the longevity of this company?
Well, I think you got to figure out, well, there's two things, right? So longevity of the company as a whole or as a part, right? So I think as a part, you need to preserve some function of Sears because Eddie, in particular, and Fairholme as well, they have a lot of value tied up in other entities, whether it's Sears Hometown, the services business, Seritage, et cetera, all these things, and even the value of the intellectual property is really dependent upon maintaining some sort of Sears going forward. What that looks like, who knows? I think once you get through Q4 and you see kind of what they did with inventory in terms of how far they ran it down, particularly heading into a very seasonally demanding Q1 for cash flow, you'll get some indications whether they're going to do something more material nearer term versus longer term.
All right, Noel Hebert of Bloomberg Intelligence, thank you very much.
All right, up next, the U.S. retaliates against Russia for cyber attacks aimed at interfering with the 2016 election. And Russia responding in a conference call, a spokesperson for the Kremlin saying that Russia regrets Obama's decision on new sanctions and that Russia has no alternative but a proportional response. In other words, some kind of retaliation on of its own. The Russia reaction, says the spokesman, will create, quote unquote, discomfort for the United States. We will have much more perspective on this evolving situation and have the latest developments from Washington next. This is Bloomberg.
The Obama administration has retaliated against Russia's cyber-active involvement in this year's presidential election, issuing a report that gave technical details about the tools and infrastructure Moscow used. President Obama said, quote, "These data theft and disclosure activities could have only been directed by the highest levels of the Russian government. Moreover, our diplomats have experienced an unacceptable level of harassment in Moscow by Russian security services and police over the last year." Obama has imposed sanctions on top Russian intelligence officials and agencies and expelled 35 Russian operatives from the U.S. The Associated Press is reporting that a Putin aide says Russia will consider retaliatory measures. Joining us now from D.C. is Bloomberg's Alan Katz, who covers crime and corruption. All right, Alan, so that escalated quickly. What do we know about what Obama has said he's going to do? What do we make of these measures? What was your reaction?
Well, the measures themselves are probably going to have a relatively limited impact. They're mostly against Russian military intelligence and the successor to the KGB, institutions that don't really use the international financial system that much, that certainly don't have bank accounts in the United States or likely in Europe, and there's probably quite a limited impact, at least in the near term, on them. They might use the international financial system for some of their operations, and so it might make it a little bit more difficult for them. But again, in the near term, the impact is limited. The more dramatic, sort of immediate impact would be the expulsion of the 35 Russian operatives in the United States. And as you pointed, Russia actually has come out with a statement saying they have no choice but to have a proportional response. And what that likely means is that we're going to go back to the situation we had when it was the U.S. versus the Soviet Union, which is where the U.S. expels a certain number of people and the Soviet Union would expel the exact same number of people. You can, according to the people I've spoken with, you can probably expect Russia to expel either around or exactly 35 people in the coming weeks.
Alan, when they said they were expelling these folks, and it's from spy bases in Maryland and New York, does that mean that there's this sort of situation where the spy agencies in the U.S. know that there are Russian operatives there, and they've just sort of tolerated them up until now? I mean, how does this work exactly?
That's a good question. It is highly unusual, I would say, to talk about Russian compounds with these operatives working there near D.C., near New York City, and then say, well, actually these people are all spies, and we're now going to kick them out. They haven't actually said that they're spies. They said they were operatives, so they might have been, I suppose, hackers working for the Russian government, maybe freelance or full time. It's hard to tell at the moment. The answer to your question is fundamentally is that it seems that the U.S. is aware of Russian officials working in the U.S. are probably actually largely declared through the embassy, just like the U.S. is aware of, Russia is aware of U.S. officials working in Russia. Which of them are working, actually working for the State Department or actually working for U.S. intelligence agencies in Russia? We don't know, but Russia might, and it might be the same thing here. These people might have ostensibly been with the Russian embassy in the United States, but the U.S. is aware that they're actually working for the GRU or the FSB or others. But it is sort of shocking. It seems almost TV-like rather than real life, but it is real life.
Alan, right after this news, right after this news was announced, the Russian embassy of the UK, which is very into trolling and memes, tweeted the following, which I have here on my computer. It said, "President Obama expels 35 Russian flag emoji diplomats in Cold War deja vu. Is everybody, including American flag emoji, people will be glad to see the latest of this hapless admin with a picture of a duck and the word lame, meaning lame duck," which is pretty funny, but it also says something real, which is that the administration is about to change. Is it possible that these will just be reversed in like 25 days?
It is possible, and one of the people I spoke with, who's a former senior sanctions official in the Obama administration, who's now in private practice, mentioned to me that you could certainly see, in fact, very little reaction from the Russian government. You could have a situation where Russia says, okay, we're going to respond, but doesn't actually do anything, waits until January 20th, waits until Donald Trump is inaugurated, and then says, actually, we've decided to turn over a new leaf with the United States. We are not going to do anything in response to U.S. sanctions. We count on the new president to roll back those sanctions, and he may or may not do that. Who knows really what Donald Trump is going to do when he becomes president. But that certainly could be part of the calculus that Donald Trump has been very clear that he wants to improve relations with Russia. Russia could decide not to do anything about today's actions, saying that this is Obama's last gasp. The new president is going to change things, and so let's not do much, and we'll see. And hopefully by the end of February or something like that, all of these new sanctions have been rolled back. That's quite possible, though I defy anyone to predict exactly what the new president will do.
Well, and Alan, at the same time, we're hearing from a number of members of Congress, most recently Senators John McCain and Lindsey Graham. We heard from Paul Ryan. We heard from Chuck Schumer, all of them in support of these sanctions. So I know you cover crimes and not necessarily politics, but is this really the first showdown that Donald Trump wants of the new administration? Is this showdown over these Russian sanctions with Congress?
It may or may not actually be a showdown. I mean, certainly Lindsey Graham, John McCain are traditional foes of Vladimir Putin and Russia. This is not a change in their position. Paul Ryan, to his statement that these are overdue but are appropriate, is in line with sort of his previous policies toward Russia. If Donald Trump comes in and says, like, this is all fine, and we don't want Russia hacking us, and if you were, Mr. Putin, please stop. But the way to address Russia is through friendship, not through sanctions. Sanctions have been in place, whether it's for cyber or for the Ukraine, since 2014. They have not changed Russian actions. They've not changed Russian minds, and so it's the wrong way of going about things. You might find a receptive ear among a lot of Republicans in Congress. Not, I would doubt, for John McCain or Lindsey Graham, but for others, you might find this. So it might not be quite the showdown that people think.
All right, Alan Katz, thanks so much for breaking down the new Cold War with emojis. That's Bloomberg's Alan Katz in D.C.
Up next, we'll take a look at the best and worst performing assets of 2016 in today's Chart Chat. This is Bloomberg.
I'm Julie Hyman. What'd you miss? Probably not the commodity comeback of 2016, but you might be surprised at what the returns have actually managed to be. Here are gold, Brent, and natural gas. Now, gold in yellow. I tried to make it appropriate here. Even though we've talked so much about the pullback since the election, gold futures actually up 9% on the year still, even despite that pullback. We have Brent rising about 30% on the year. That's the white line. But natural gas is the big winner, up 62, 63% year to date. So looking like a big year for natural gas, the year of 2016. Of course, all of these commodities did fall in 2015. What are you looking at for the year?
That chart goes very nicely into mine because, of course, with the commodity rally, excluding gold, even though it's up, the big corporate bond winners in the high yield space, also commodity companies. If you bought into Cliffs Natural Resources or Chesapeake Energy, some of their bonds expiring in the years ahead, earlier on in January and February, when it looked like the world was falling apart, you could have made over 300 to 500% on your money. Of course, you had to have guts, catch a falling knife, but it really was some of those commodity companies based on energy and iron ore that were the huge winners.
Wow, that's a pretty massive return. You guys left me so much time for stocks. All right, I'm looking at what's happened in the U.S. equity market that hasn't really happened elsewhere in the current rally. So this is kind of a year-end, but it's mostly really what's happened since the election. Let's start right here, which is what's happened since November 8th. Basically, the yellow line here is the S&P 500. We're up about 5%. Nothing really to write home about, but what's interesting here is that you've basically got all these emerging markets, LatAm, and other stock markets that aren't doing as well. If you look back at all the other rebounds post-Brexit in February, August, October last year, even back to 2011, that doesn't happen. This is really the only time in which we've had a rebound in U.S. stocks that nobody else is partaking in. So.
Divergent.
And it really shows how you've been punished for diversification in this post-election
and
market.
how much we love colors.
Yes.
The market close is up next. Here are the major averages. Less than 4 minutes until the close. Sadly, only one color on this screen today, and it's red. This is Bloomberg. We are moments away from the closing bell. What'd you miss? Stocks nearly unchanged on this second-to-last trading day of 2016. Volumes continue to be light. Financials, energy, consumer discretionary leading declines. Treasuries, though, extending gains after a strong 7-year auction. The dollar continues to fall. I'm Julie Hyman.
I'm Joe Weisenthal.
And I'm Oliver Rennick.
We want to welcome our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
And we begin with our market minutes on this penultimate trading day. I love to use penultimate.
Me too.
That's the
as
word
much
of the day.
as I
You
can.
should have used antepenultimate yesterday. That would have been.
Should have done that. We were too busy using your other word of the day yesterday.
All right. asymptotic. Let's start with stocks. Some sectors first. Let's check out what's happening with some of the winners here the past 5 days because they gained again today. Utilities group is up. Real estate is up. This has been the case in the past week, and it's interesting because we're still in this post-Trump rally, but the contour of it has changed quite a bit, right? Financials are down today. They're down over the past 5 days. That sort of value versus growth play, which I'm going to talk about later in the show, has also sort of flattened out a little bit. So there are some interesting changes. Let's look at a few companies real quick, switch over the boards. A few big movers here. I picked these basically based on their volume. Newmont Mining was upgraded today by an analyst, so it jumped about 8%. Also traded quite a bit above its average volume. CMG, Chipotle, still hurting, down about 2%. No big news out of there, some Twitter on social media, et cetera, but it's still hurting down again today on heavier volume. And then again, NVIDIA today ended up in the green, but still on lots of volume. There wasn't any huge news. This is just still a lot of people that are in the stock after Andrew left of Citron's short call. And then we're going to jump into the terminal real quick. We got VIX and stocks here because this isn't a huge deal, but people sometimes freak out when the VIX and the S&P 500 move together, which they have been quite a bit. Here's the VIX, basically up a little bit today, even as the S&P 500, sorry, here's the VIX, up again today, even while the S&P is flat, up again. Yesterday, S&P was down. It's basically how these updates, though, where the S&P is either flat or down. That happens like 20% of the time, which people over-exaggerate. But it is interesting that volatility is climbing, I think.
All right, on bonds, let's take a quick look at the U.S. 2-year and 10-year yields lower today. Remember, there was a pretty significant move higher, lower yesterday in the 10-year yield, so we're seeing that continue today. Fairly significant action over the last 2 days in U.S. 10-year yields. We were in the mid 2.6 last week, so we've come down significantly on that. Keep an eye on that. While stocks haven't moved much, we are seeing action here.
Well, it's interesting to see the flip of the post-election move in stocks in terms of the individual groups, in bonds, and in the dollar as well, right? We've seen weakness over the dollar. It could be a little bit of repositioning here at year-end for tax purposes. We tend to see that in the last week of the year. In terms of currencies and the individual currencies, if you take a look, we've got a dollar weakness across the board today, at least versus the major trading partners. So the dollar lower against the yen, lower against the euro, which is up at 104.82, and the pound as well, strengthening versus the U.S. dollar. One of the big winners on the day, the South African rand, and it's also one of the best performing currencies this year. So that's the dollar falling versus the rand on the day. We saw the trade gap narrowing month over month in that nation.
And finally, let's take a look at commodities. Not a whole lot of action once again. Coffee, one of the gainers, up 1.4%. Gold futures up 1.5%. It's been staging a bit of a rebound in these final several days of the year. You obviously showed that gold chart in the last segment, but keep an eye on this. Kind of also fits with the rebound in treasuries, so some of these safe haven assets that had done well, then done really badly, all catching a bid here in the late days of the year. And NYMEX crude down 0.50. Yesterday on the show we had Bob Cinch, who said yesterday could be a huge day for oil as it might be a top. So for now, his call is holding.
Yes, but you won't know until after the fact, he said. So we'll see. Those are today's market minutes.
All right, up next, how President-elect Donald Trump's hard stance on immigration may end up hurting several of the states that helped him win. This is Bloomberg.
I'm Taylor Riggs. Let's get to the first word news this afternoon. President Obama retaliated against Russia for cyber attacks aimed at interfering with the 2016 presidential campaign, imposing sanctions on top Russian intelligence officials and agencies. 35 Russian operatives will be expelled from the U.S. As part of the response, the FBI and Homeland Security Department have also released a report with technical evidence intended to prove Russia's military and civilian intelligence services were behind the hacking. Russian President Vladimir Putin's spokesman says Moscow regrets the new U.S. sanctions and will consider retaliatory measures. Meanwhile, the GOP is reacting to the Obama administration announcement. House Speaker Paul Ryan and both Senators John McCain and Lindsey Graham call the sanctions long overdue. Ryan says the move is a prime example of the administration's ineffective foreign policy that left the U.S. weaker in the eyes of the world. McCain and Graham say they'll push for stronger sanctions. And a ceasefire in Syria's civil war will take effect at 5 p.m. Eastern Time. The truce was arranged by Russia, which backs the Syrian government, and Turkey, which supports most of the rebel forces. Syrian TV says the agreement paves the way for talks aimed at ending the conflict. Russia says President-elect Donald Trump's administration can join the peace process once he takes office. German prosecutors say they've released a Tunisian man who was detained. They determined he was not in contact with the main suspect in last week's Berlin truck attack. Federal prosecutors said at the time his telephone number was saved in suspect Anis Amri's cell phone and that they suspected he may have been involved in the attack. Amri is believed to have driven the truck that plowed into a Christmas market, killing 12 people. His fingerprints and wallet were found in the truck. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
What'd you miss? Donald Trump's tough line on immigration could do major harm to some of the states that helped elect him. Pennsylvania, Ohio, Michigan, and Wisconsin account for 12.4% of the U.S. population, but this past year they accounted for just 1% of the country's population growth. New census data shows that if it weren't for immigration, the populations in these four states would be falling significantly. Joining us for more is Connor Sin, Bloomberg View columnist. Connor joins us from Atlanta. So obviously part of the narrative, a big part of Donald Trump's campaign was that these are states and parts of the country whose jobs have left, whose jobs have been taken, whose manufacturing industry has departed. But you're saying basically a lot of it might actually just be an issue of population.
Yeah, so for instance, in those four states you mentioned, they had 88,000 new immigrants come in, only about 23,000 in population growth over the past year. So if you take out those immigrants, the states would have all lost population, and that's sort of been the trend for a while now. And when you have factors like baby boomers retiring and maybe moving to warmer states, and their millennial kids following them or something else, they really need an influx of people from somewhere to keep growing, and that place is probably going to have to be immigration if it's coming from anywhere.
You know, Connor, there's this endless debate. It's on Twitter a lot. It's in columns where people say, why did people vote for Trump? Was it about culture and race, or was it about economic anxiety and economic decline? If it's about economics, then you make a compelling case that they need more immigrants to boost the workforce and stuff. But if it's about cultural anxiety and fear of change and basically not wanting their lifestyles to change, then ultimately an influx of immigration doesn't really get at what concerns them and might even further drive them to support Trump. No?
Yeah, it's sort of, if those are the two options, neither choice is that appealing, because if you don't bring in immigrants, if you sort of appeal to the cultural sensibilities, as you point out, then you're looking at perpetual population loss. I mean, you have perpetual population loss. It's bad for economic growth. It's bad for employers looking for workers, bad for the tax base, and on and on. And, you know, on the other hand, if it's economic, then so you really have to pick one or the other, and it's just kind of a no-win situation.
At the same time, if you have sort of this slow population growth or population stagnation in some of these states, is that a problem economically? I mean, at least in theory, you would have fewer people competing for the same jobs, right?
Sure. So one of the things is that in a lot of these places, the unemployment rate's actually very low. So if you look at just that measure of economic health, you would say that these places are doing quite well. However, if you look at the vote history in terms of who voted from these sort of Obama-Trump voters, the people who switched over, One of the things that Nate Cohn at the New York Times pointed out is that if you look at the percentage of houses that were built before 1970, so an older housing stock, that's very highly correlated to these places that went from Obama to Trump. So it's sort of, it's not just people getting jobs. It's just, does it feel like it's growing? Does it feel like it's changing in a good way? And so in a lot of these cases, the answer is no.
Connor, you wrote another column today for Bloomberg View about the labor market ramifications of a potential Trump stimulus. We're close to what economists call full employment, or what they believe full employment is. So in theory, any sort of stimulus will draw workers from one area of the economy into another, not creating any net gain. What industries are most vulnerable, in your view, for an ongoing tightening of the labor market from a government stimulus?
I'd say construction. Construction's been the sort of canary in the coal mine for tightness for a few years now. And potentially in 2017, you could look at 3 different factors all pulling construction workers. You could say housing, which has been the case for years. You could say infrastructure, and the federal infrastructure could take a while, but state and local governments have been passing measures, so there's that factor as well. And then as energy comes back, the energy sector laid off a lot of workers over the past few years as the price of oil declined. And now that oil is coming back and potentially energy employers want to rehire people, those people might have gone to other places. So, where are you going to find workers to fill all 3 of these industries?
Hey, Connor, so this basically comes back to the discussion of the full employment, where that exists, where the fulcrum exists at which inflation starts to rise. So we know we're basically past, a certain level of employment here, but given how sort of sluggish inflation has been, is it possible to where you could have a fiscal policy that pushes employment lower to a level that perhaps we didn't think prior to this was a floor?
Absolutely. If you look at the change in the workforce over the past 20 years, the 2 biggest changes are how the workforce has gotten older. And we know that older workers have a lower unemployment rate. So that's one sort of compositional factor that should lead to a lower unemployment rate. And the other is that the educational level of the workforce has increased. And more educated workers have a lower unemployment rate. So just based on those 2 factors alone, you could get down into the upper 3s and potentially not have this runaway inflationary spiral. And we'll just have to see over the next 12 to 18 months if that happens.
Connor, what you also discuss in your piece today is this 2 sort of missing pieces in the labor market right now are the participation, which still remains at a relatively low rate historically, and productivity. Now, presumably, participation will rise if wages start to rise further. But what do you do about the productivity piece?
So that's actually related to this as well. So one of the arguments for why productivity has been so low over the past 5 years is that wages have been so low. And so if you're an employer with money looking to grow, you can just hire cheap workers rather than invest in equipment and factories. And so if labor gets tighter and wages go up, all of a sudden it creates the incentive to invest in equipment and machinery instead. And that's presumably what would drive productivity growth in the years to come.
All right. Connor, great stuff. Connor Sand, Bloomberg View columnist. Check out his columns on the Bloomberg at Bloomberg View.
And coming up, the S&P 500 has gained 10% in 2016 as the bull run hurtles into its 9th year. But one valuation metric is signaling a warning to investors. We'll discuss whether you should pay attention to it. This is Bloomberg.
us now to talk more on markets is Meb Faber, Cambria Investment Management CIO. Meb joins us from Los Angeles. Meb, thank you very much for joining us. We've been talking a lot on the show lately about sentiment, whether we're getting towards euphoria or not. But let's talk hard numbers. When you look at U.S. markets from a strictly valuation perspective, you do a lot of work on this. What are they telling you about future returns?
You know, that's actually an interesting comment about sentiment, because if you look at the sentiment AAII going back to the 1980s, we actually had one of the lowest bullish readings ever in January, February this year. And historically, the following 12 months means you have something like mid-teens returns, and nobody wanted to buy stocks in February, but ironically, that's what's ended up happening off the bottom. But as the market has increased, valuations have got stretched. You know, we look at the 10-year PE ratios, call them Shiller Cape ratios. They're around 27 right now. So not horrific, not as bad as they were in the 90s, but kind of like 96. So getting expensive. But we're in a strong uptrend. We're now in the second longest bull market ever in the Dow. If we make it to the spring, it'll be the longest ever. So the bull market's getting certainly, it's not the biggest by magnitude, but it's certainly getting pretty long in the tooth as far as time. And so as we kind of get to the end of the year, double-digit returns in the S&P, probably more caution is warranted. We think there's a lot more opportunity elsewhere in the world.
Meb, so we basically look at the Cape ratio, and it's an interesting measure. When you look at what's happened throughout the bull market, I mean, if you had gone by this measure, you basically would have missed out on most of the bull market. But even beyond that, just to play devil's advocate here, isn't it sort of built for a different world? And before we actually get to that, let's just look at this chart right here. This is basically what we're showing here is where the Cape is. Standard deviation, sigma right there. We're above one standard deviation from the average. Obviously, we've been above that several times throughout this bull market. But the question about the Cape fundamentally is that can we still apply it in a very different economy, especially a services-related economy?
I actually love that example because it's a great illustration of how valuation works. So let's go back to 1993 when valuations first popped above 20 in this kind of regime. Since going back to, you know, earlier in the 20s, they got really high. But let's say when they first crossed above 20, you would have missed out on something like 800% gains in the S&P if you simply sold and moved on. However, no one just puts their money under a mattress. If you park that money in bonds or park that money in long-term bonds, you would have ended up in almost the same place as stocks because you've had a great bond bull market, and you wouldn't have had the same drawdowns. And so there's other alternatives, and there's things you could do like, hey, you could invest in bonds except when stocks are cheap by Cape ratios. So stocks got really cheap in 08 and 09. Most people don't remember that. It got into the lower teens. But that's not the best way to use it. The best way to use it is say, you're not just confined to U.S. stocks and bonds. The world is your oyster. You should invest where valuations are cheapest anywhere. So if instead of just saying, hey, are U.S. stocks expensive or cheap, you said, what are the cheap assets in the world? And let's say you bought the 25% of cheapest global stock markets each year, rebalance once a year, that would have beat both of those by just leaps and bounds. It would have beaten the S&P, you know, by over 4 percentage points per year. And that's the world we find ourselves in right now. If you look at global markets, much cheaper. Cape ratio is around 16, 15, I think, for foreign developed. For foreign emerging, it's the low teens. And then if you buy the cheapest basket, so the Brazils, the Russias, the Eastern Europes of the world, you end up a Cape ratio of about 9. So that's almost a third the valuation of the U.S. And historically, that means double-digit returns going forward, whereas we forecast for the U.S. stock market maybe about 5%.
And Meb, when you're trying to project any of this forward and look at forward valuations, forward PE, and not necessarily looking at Cape, given all the political events that we've had here in the U.S. with the prospects for fiscal stimulus, what's going on in Europe, I mean, is there a way of quantifying these kinds of events when you're doing your valuation metrics?
Yeah, absolutely. You quantify them by just ignoring them. And that's the thing with valuation is most of these valuation indicators, they all say the same thing. Doesn't matter if it's 1-year forward earnings, 10-year prior earnings, if it's dividend yields, if it's cash flow, book sales. We look at about 5 of them and take the average on a 10-year basis. And because valuation is a blunt tool. You're not trying to predict what's going to happen next quarter, what's going to happen, you know, even next year, but really over the next 3 to 5 years. And so if you look back The U.S. stock market since 2009, #1 stock market in the world out of 45 countries. That is an incredibly rare phenomenon. U.S. versus foreign is usually a coin flip. And if you compare U.S. versus the really cheap bucket, so taking a value global approach, that only outperforms in 60% of all years. So it's almost a coin flip. It's underperformed in 2013, 14, and 15, 3 years in a row. It's had a monster year this year, up almost 20%, largely due to the Brazils and Russias of the world that are up 50, 70%. And if Europe ever gets their act together, I think that's when you can really see continued explosive returns out of a global value strategy.
Meb, I want to go back to what you said about sentiment. If we go into my Bloomberg, because I made a chart of what you were talking about, AAII bullish sentiment back in January, hitting its lowest level in 5 years. Then after the election, and I hadn't realized this until just now, we saw a gigantic spike of the number of people who said they were bullish from below 25% to nearly 50%. Historically, when you see gigantic spikes like this, do they say the flip side? I mean, you mentioned that returns are really good when sentiment is this negative. What is such a flip in sentiment towards bullish tell us about the future?
You get a little bit of what Ned Davis talks about, these sentiment thrusts. So yes, you can have a bullish perspective from that. But when you're looking at sentiment, it really only matters at the extremes. You know, people spend most of the time in kind of the middle. But my favorite part about the AI series, so you go back to 1987 when they started calculating it, the single month when people were most bullish in the entire history of the sample, you could probably guess this, January of 2000, the literal worst month to be bullish in the entire last 30 years is when investors were most bullish. Guess when they were most bearish? You could not make this up. You could not come up with a more ridiculous survey answer, March of 2009. And so the sentiment, you know, it's really useful at the extremes. Most of the time that we spend in the middle, I don't know how useful it is. Interestingly enough, they have a second survey, which is not do what I say, it's do what I do. And they ask, how are you allocated? And ironically, most of the people spend most of the time in the last year saying, we're not that bullish, but their stock allocation is high. And that's largely because stocks have just increased in value. And so what you really want to use those type of surveys, it's often a coincident indicator with what else is going on in the world. So when stocks are expensive, the sentiment's usually bullish and high, which is what it shouldn't be. And on the opposite, you know, where the sentiment's really bad is usually when valuations are low and people, when you want to be investing.
Great stuff. Love having you on. Meb Faber, Cambria Investment Management CIO. Thank you very much.
And now let's take a deep dive into the Bloomberg. You can find all the following charts using the function at the bottom of the screen. I wanted to start with the solar industry because as we've talked about, a lot of risk assets rallying this year, particularly in the wake of the election. One of those that has decidedly not participated is the solar industry. And this is as measured by the Guggenheim Solar ETF TAN, appropriately enough, is the ticker here. Yeah, you like that? It's down about 40+% year to date. And then the other line here is the average silicon solar module spot price, because after all, you're talking about panel makers, it's a commodity, and that has also slumped. We've seen the cost there go down, in part because China's expansion in the industry has been so rapid. It hasn't helped the stocks, of course. The stocks are down for many of these companies, but we have seen an expansion in production, an expansion of adoption of solar power to some extent as well, but it has not been good for
So good news for the world if you believe that solar is good for the world, cleaner energy, you know, weaning off fossil fuels.
Right.
Just not good for the people who sell us.
Not great for pricing power.
And then, of course, you put also the incoming administration and the regulatory environment of the renewables industry. So it'll be interesting to see what this chart looks like.
Yeah, maybe we'll go back a little bit.
All right, I'm looking at one of my favorite ratios, which is pricing the stock market in gold, S&P versus gold. And the reason I really like this, people think it's silly to price things and other things, but I like it because S&P companies represent human achievement, people creating new things. Gold represents rocks, or that'll cause people get upset that I called it rocks. I guess it's metal, the opposite of human achievement. Anyway, we're up a long time from the lows, which is in 2011, but we still have a very long way to go back at the peak. Actually, what Meb was just talking about, back in 2000, people were so optimistic about everything. No one wanted metals. So if we are going to get anywhere back in the old days, we still have a long way to go.
Man, I thought the cape was outdated. You're comparing it to rocks.
Rocks are, they last a long time.
I love it. It's great. Always good to have another valuation measure. Let's keep it with stocks. I'm looking at what's pretty much happened over the course of the past year here. In particular, I just want to sort of give an update on what's happening. Blue lines show flows into the S&P 500 ETF trust. Boom, positive, positive, positive. Bonds down here, if you look at the LQD, still negative. Here's what's interesting on the bottom panel, though. If you look where people have been going, this was a big push to value, and now that's flattening off a little bit. So, you know, it's the trend is shifting, I guess, a little bit here.
All right, we have to go to break then, and we will be right back. This is Bloomberg.
I'm Taylor Riggs. Let's get to the first word news this afternoon. Russia is calling the U.S. sanctions announced today an aggressive move by the Obama administration and is planning a proportional response to the U.S. expulsions. That's according to a Kremlin spokesman who spoke on a conference call. According to Interfax, Russia will announce those countermeasures on Friday. Interfax is citing the Russian Foreign Ministry. Argentina has reopened its investigation into an accusation against former President Cristina Fernandez. She's accused of covering up an alleged Iranian involvement in the 1994 bombing of a Jewish community center. 85 people died and hundreds of others wounded. The accuser, Alberto Nisman, was also found dead. Earlier this week, a judge approved fraud charges against Fernandez and 2 aides and ordered her assets frozen. 2016 was a deadly year for law enforcement officers across the U.S., with 135 killed in the line of duty. That's the highest level in 5 years, according to the National Law Enforcement Officers Memorial Fund. Firearms were the #1 cause of deaths, with 64 officers shot and killed. That's up 41% from last year. Nearly 1 in 3 officers fatally shot was killed in an ambush-style attack. And U.S. state colleges and universities are facing funding challenges, and they're turning to full tuition-paying students from abroad to replenish their coffers. The Institute of International Education finds the number of international students is up 7% from last year and 85% over the past decade. The rising demand from abroad has helped keep U.S. public colleges afloat. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
Thanks, Taylor. Let's get a recap of today's market action, such as it was. We saw all three major averages pull back, but the Dow and the S&P barely budging, the NASDAQ budging a tiny bit more, down 0.1%. But we have seen a reversal of a lot of the trends that we've seen since the election in the past week or so, including a little bit more weakness in stocks, weakness in financials, as well as weakness in the U.S. dollar and some buying happening in the bond market.
All right, thanks, Julie. What'd you miss? If President-elect Donald Trump holds true to some of his trade promises, the U.S. could find itself at a trade war with China. So who would outlast whom and who would take the biggest blow? Joining us now from D.C. is Derek Scissors. He's chief economist at China Beige Book International and resident scholar at the American Enterprise Institute. All right, Derek, give us some good news. So trade war, U.S. coming out on top, right?
Yeah, I guess if that's good news. It's kind of like being shot in the foot and shooting somebody else in the stomach. But yes, if we have a trade war, which is a bad idea, and people will get hurt, and people in the United States will get hurt, the U.S. will win. So if that's good news, I've got it for you.
So what's behind basically the analysis that you did? Because part of this I know is the longevity with which China can hold on. Is that just because of a sort of stimulus buildup? Do we have that here as well?
Well, I mean, the number one thing is you're taking China on one hand is a country that's bleeding foreign exchange. You guys cover it all the time. A lot of money moving out of China, people worried about it. And they're taking on in the United States the reserve currency country, which means we don't need foreign exchange because the dollar is hard currency. So they're getting $300 billion a year roughly out of the trade surplus they have in the United States. Ultimately, if the trade war goes that far, which no one should hope for, the U.S. cuts that off, China loses, and there's really no other way. There's no way around it.
Do you imagine that somehow the trade relations with China during the Trump administration will settle into something that allows him to claim a victory without actually altering the fundamental dynamics very much? And what could that look like?
No, that's very possible. That's even likely. I think what you're going to get from the Trump administration from the start is things like calling China a currency manipulator, which doesn't require tariffs, tariffs on steel, which Secretary of Commerce designate Wilbur Ross has long talked about, things that aren't really going to change the relationship that much. Now, if China goes along with those, knowing that they're not big changes, they're not really going to hurt China that badly, President-elect Trump can declare victory and move on to something else. He's got a lot of other things on his agenda, obviously tax, health care, and so on. The question is what happens if China retaliates or China depreciates its currency further. Then I think you get a spiral where we get back to that big trade war scenario.
And Derek, given that we've had sort of a muted response from China thus far, it seems to me the officials there seem to be waiting until the Trump administration actually takes over and actually perhaps comes through with some of its campaign promises. But given what you know about the Chinese government, what do you think the stance will be? Do you think there will be sort of this retaliation that you're talking about?
I think there'll be more talk than action, notwithstanding people talking here about how China would win a trade war. The Chinese know they would not win a trade war. They don't want to go down that road. They know they benefit tremendously from their economic relationship with the U.S. So there'll be a lot of talk. There'll be articles in Chinese newspapers and people making statements. But I don't think they want to act. So we'll have headlines. We won't necessarily take action. Now, that doesn't mean the U.S. can do whatever it wants without Chinese retaliation. The year coming up is a big political year for China. They have a 5-year meeting of their Communist Party Congress. They're going to have their sore spots. So I think they'd like to be cautious. And if we can be somewhat restrained on our side, I think we get back to the mostly status quo point that you guys raised earlier.
Derek, let's talk less about the theoretical stuff that might happen in the new administration and talk about what you see right now, the China Beige Book. How are things looking?
Well, we have, a story that splits into two parts. If you just want to look at the fourth quarter, our story is very similar to a lot of other people's, which is it was a good quarter. It was China's fourth quarter was better macroeconomically than its third quarter. The Chinese report these very stable, artificially stable statistics that no one believes. But if you do a 3,100 firm survey, as we do, you get better evidence. The fourth quarter was a good quarter. The downside is 2017 doesn't look as good. And I say that because cash flow at these firms is weaker, new orders are mediocre, inventories are building up. So we have two tales here. One is right now things are better, a lot of evidence of that. 2017 we may get back to worrying about Chinese weakness again.
Derek, one of the themes of the equity market in the past year was that, really the currency market as well, was that the weakness in Chinese currency and their surprise devaluations was bleeding through into other assets. That largely, even though their currency has gotten significantly weaker, it hasn't really been a major talking point. So when you look through the economic data here, does the devaluation of their currency, the weakening of their currency, correspond to what you see on the economic side, or is one outpacing the other?
You know, China's a big economy. It's the second largest in the world. Really what happens there domestically matters more than what happens internationally. Of course, there are companies affected by the weaker yuan. If they're exporting, it's good. If they're importing, it's bad. There's financial firms that are affected by capital outflows. People lose confidence in the currency. But what really matters is internal Chinese policy. So I'm really not seeing the depreciation affecting most firms. There's just too much construction. You know, property is a big sector in China. The manufacturing sector serving the Chinese market is huge. Chinese consumers are relied upon by a lot of the world, maybe unwisely. So depreciation matters, the balance of payments matters, but when you're talking about internal China, it's really their own policies, their own debt situation, not the currency.
You know, another thing that I think is interesting as we start to speculate on what Trump is going to do in his administration. There's obviously talked about tariffs, putting up some limitations on trade, and the idea, it seems like the market has interpreted, is that the emerging markets around the world and really other countries are going to fall way behind. But I guess if the U.S. is growing at a GDP that is, you know, above what we've seen, almost double. Some people are saying, all right, if we GDP up to 4% next year, then won't the rest of the world still benefit, even if it's by a lesser relative amount on the margin?
Yeah, I agree with that. I think the question that traders are facing is the timing of this. In other words, you're not going to snap your fingers and suddenly get the U.S. economy accelerating.
Right.
And you can snap your fingers and very quickly have U.S. trade disruption that affects emerging markets. So if the Trump administration comes out of the gate, as I hope they will, with tax reform, with actions to strengthen the U.S. economy, then I think the emerging market problem is overdone, because you'll get good timing, maybe U.S. trade actions, but also U.S. growth. If they come out with trade protectionism, that's where the threat to the emerging markets comes from, because even good U.S. policies aren't going to work in February or March of next year.
Derek, one key point about China that also gets people very anxious: capital outflows. It appears they're continuing strong. Any signs of stabilizing on that front, and any signs that what the government has done, various measures to tighten, seal in money, any signs that that's working?
Well, it'll work a little bit. I have a data set on Chinese outward investment, and you can see the change in November and December compared to earlier in the year, with Chinese companies rushing outwards for new projects and acquisitions, and then slowing down dramatically in November and December. But all that's going to do is slow the bleeding. To get it to stop, you need to do something dramatic. That's why some people talk about devaluation. I think that would fail miserably. It would just cause more capital outflow. What you really need to do is make China a better place to invest. Chinese money is leaving China because they'd rather go someplace else. If you make China a better place to invest, give more opportunities to private capital, that's how you keep capital from leaving. So the capital controls will work as a Band-Aid, but what China really needs to stop to address this problem is internal reform, and we're not seeing it, and that's pretty worrisome.
Now, I was just going to pull up right here, Derek. We're looking at basically those outflows. Chinese foreign exchange reserves just down, just as Joe was saying, not really showing a whole lot of signs. I guess it's kind of plateaued here a bit, but definitely something to keep watching. Derek Scissors, chief economist at China Beige Book International and resident scholar at AEI. Thanks so much for joining.
Well, coming up, the worst may be over for industrials in 2017 after 3 tough years. And there may be some bright spots under a Trump administration. We'll have more on that. And here's a look at how some companies have done so far this year. Some strength in those industrials. This is Bloomberg. What'd you miss? We're looking at what the year ahead holds for the various industries. Today we're focusing on industrials. Joining us now is Bloomberg Intelligence senior analyst Karen Ubelhart. Karen, will demand for industrials, do you think, be better in 2017 than we saw in the past year?
I think, in a way, 2017 could be a flip of 2016. It was a little bit more disappointing on the growth side than people expected. In the second half, actually, there was negative organic growth for a lot of these companies. I think you'll start to see modest growth next year, particularly in the second half better than the first half. But there's not, in my view, going to be a snapback of any kind.
What are the factors that you look into in terms of where the demand is going to come from? Is it U.S.? Is it international? Is it stimulus-based? Like, what ultimately will be the drivers of the industry?
All these companies now are pretty global, so in most cases it's at the top level, what does global GDP look like? A lot of the more cyclical industrials are focused on commodity markets. So, what's copper doing? What's steel doing? What some of the major commodities, ag commodities. So a lot of them make mining equipment, ag equipment, energy equipment. So they're tied to commodity markets. That's another big factor. And of course, there is always, a lot of the reason these stocks ran is hope on what Trump might do, and a lower tax rate and infrastructure and other things helped industrials as well. So.
All right, let's talk about the Trump boost, because as a stock market reporter, this has been pretty interesting to watch some of the companies and sectors that did really well right after the election. Let's jump into my terminal, because I've got a breakdown of the industrial sector itself, taking it down to GICS level 3, looking at some of the different industries within industrials. And there's a big difference, right? It's not, gains all across the board. You basically got trading companies and distributors up about 9%. You've got engineering industries up 7%, and then, 19 and 17. But then when you go back down to some of the aerospace companies, you go down to some of the more core industrial, 7.5%. There's a lot of disparity here. So what exactly is it within the expectations for next year that's created sort of the difference between the industries here?
If you look on if you look at like multi-industrials, which are more stable companies versus more cyclical ones like Caterpillar or Deere, there's been a huge bifurcation, and that usually happens when people are anticipating accelerating economic growth. The cyclicals take off. And prior to the election, the machinery companies were up 40%, and that was even before Trump. Post-Trump, they ran further. The multis were up like 9–10% because people were expecting next year GDP is going to be better. These cyclical companies get the leverage. These are the ones I want to be in. You look at so anything sort of commodity related, economically sensitive related, they really ran. More stable ones didn't. Healthcare kind of slow, steady. Industrials aren't healthcare. Aerospace also more like slow, steady growth, not a ramp up. So you saw those sectors not, those companies in those sectors not pop as much. They really wanted to be in the big cyclicals in hopes that next year is going to be a 3% year, not a 1.6% year. So.
Now, when you look at next year and you look at the potential for infrastructure spending and tax cuts, as you talk about, we look at the recent run in commodities. So some things, and GDP growth, these things that would be positive for industrials. Are there any big risks looming for the sector potentially?
I think there's always the geopolitical risks, right? Europe is a very big market for these companies, 25%. There's not a great story there. China has been an incrementally growth market for them. Now, it's been rough for a couple of years, but if that slowed down, it's more like sort of regional risks, I would say. The U.S. construction market is a very important market to these companies, so if that's been slowing all year, if it continued to slow, that would be a risk. My sense is it's going to be stable or maybe a little better if some of this stuff gets done. So.
I look at something that's been a big story within the equity market and for these companies has been the use of money for Capex versus shareholder-friendly activity. Mm-hmm. I got another chart in the terminal. This comes from he's our quant, Kevin Kelly at Bloomberg Fundamental Data. This has basically been a trend down, right, where Capex, you've seen, this is for the S&P 500. Now, good, but this comes from some of these industrial companies. I think people are going to expect that to go up next year. You can see the tick up here the past 6 months. I wonder, when you guys do your assessment of some of these companies, how are they going to weigh the economic expansion and the ability to do Capex on the back of that versus saying we already have these sort of programs in place for buybacks, dividends, all that type of stuff?
I think you'll see a slowdown in the latter. there was huge, again, the Capex cuts in the commodity-related markets are down like 70% in terms of spending. Next year, most of the companies are looking at flat, maybe up a little, maybe down a little. That they're not expecting to all of a sudden, raise capital spending 20%. Companies always would rather be investing in their business and, getting, earnings out of their business rather than, a buyback is I've got free cash. There's theories that say it doesn't even over the long-term pay, but they've got so much money, they're not reinvesting it in the business. They've all been shrinking Capex. I think, other things, all things being equal, they'd rather spend it in the business.
Yeah.
So.
All right, Karen, say your last name for me.
Ubelhart.
Ubelhart. I did an okay job the first time.
Yeah.
Thank you so much, Karen.
Okay.
Appreciate it. She's a senior analyst at Bloomberg Intelligence.
All right, up next, we'll hear what analysts and business leaders say are the most significant risks to the global economy and international politics coming in 2017. This is Bloomberg.
What'd you miss? Bloomberg asked some of the biggest newsmakers in business and finance about the biggest risks in 2017. One recurring theme, the uncertainty surrounding geopolitics.
The biggest risks that I see in 2017 are two. First, it is the expectations being so high and the inability of government to move as quickly as those expectations might be. All presidents come in with great ambitions and expectations, and then sometimes they just can't achieve everything at once. So expectations being lowered is a big risk.
The weakening of democracies in Europe and even perhaps in the United States, we're seeing a wave of right-wing populism that will just sweep away the pillars of democracy if we're not careful. North Korea, if North Korea acts out in January, February, or March to get attention by an attack on South Korea, that's a risk. India and Pakistan, the war, the struggle between them is heating up. Deaths on both sides of the line of control. They're both nuclear weapons powers. A lot for President-elect Trump to think about.
The biggest worry actually is really Donald Trump makes good of his campaign promise, which is really start to impose some kind of restriction or tariff on trade. Other than that, I think 2017 world economy economic policy are all on the pro-growth side. So I'm actually quite optimistic about 2017. I think the world growth will be better than 2016, and I think the asset prices will be higher.
As we look at 2017, clearly the overall business environment and political environment are things that we watch very closely. And those could have big impacts on the economy one way or the other. The other is obviously anytime there's any kind of exogenous event, whether it be a terrorist event or things of that nature, that could impact consumer confidence around the world. So we're always doing that external look at the business environment and trying to understand those type of things that would impact consumers, impact government approaches, regulations, things of that nature.
I think that there is the possibility always of a black swan, some foreign policy crisis we don't anticipate today, or some economic crisis we don't anticipate today. Remember, George W. Bush came into office and he expected to do many things, and 9/11 happened. We don't know what will happen that's unexpected, but I think the unexpected is really the biggest risk.
Those were Carlyle Group co-founder David Rubenstein, Harvard professor Nicholas Burns, Brandywine's Chen Zhao, and Ford CEO Mark Fields on the most significant risks in 2017.
All right, it's time now for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. The Bill and Melinda Gates Foundation will invest as much as $140 million in closely held Intarsia Therapeutics. The funds will be used to develop an anti-HIV therapy that uses the company's implanted device. If the program goes well, Intarsia says the foundation may give up to $90 million more. Palladium is the only precious metal to rise since Donald Trump's surprise election win. Gold, silver, and platinum have all slumped about 10% as the president-elect's pro-growth policies help strengthen the dollar. But palladium, which is used in catalytic converters to curb emissions, has gained along with surging auto sales in China and stabilizing vehicle sales here in the U.S. And finally, Mobileye, the software maker for driverless cars, jumped the most since August after announcing a partnership with the German Mapping Alliance. The group includes BMW, Audi, and Daimler. The car makers say Mobileye's technology will be integrated into navigational mapping systems. And that is your Bloomberg Business Flash.
Coming up, what you need to know to gear up for tomorrow's trading day. This is Bloomberg. What'd you miss? Well, we did see a little bit of a pullback in the markets, but really more significantly, a reversal of some of the recent trends, post-election trends that we have seen across asset classes. In the meantime, don't miss this, the last economic data point of the year here in the United States, Chicago PMI tomorrow, 9:45 a.m. Eastern.
And tomorrow afternoon, I'll be looking at the Baker Hughes U.S. rig count, U.S. oil activity picking back up with this rise in prices, potentially a threat to the rally. We'll see how much further it has to go.
All right, I'm going to be watching. Can't really watch it, but we'll try and assess the move from stocks to bonds as people rebalance at the end of the quarter and at the end of the year. Everybody's talking about it, so we'll see what we can find out.
Yes, we will. That's it for all you. That is all for what you missed.
That's it for all you watchers. Have a great evening.
This is
Bloomberg.